So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to grow your wealth. Hey, I'm your host, Brett Swarts, and each episode I am joined by some of the best real estate minds, financial and wealth advisors in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He is actually a repeat guest, and he is out of the great state of Illinois. And he's a man on a mission to help you think differently about your money, your economy, and your future. After graduating with the 6 figures of student loan debt and discovering a way to turn his debt into real wealth, as he watched everyone else lose their retirement savings and home equity in 2008, he knew that he needed to find a more predictable way to meet his financial objectives and those of his clients. He's a certified financial planner, a 2-time #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with proven, tax-efficient financial solutions. And he is here to share some more wealth and knowledge with us. We're going to cover the 3 secrets to your own banking system to invest into real estate. And so please welcome to the show with me, Mark Willis. Hey, Mark, how you doing?
Hey, Brett. Doing great, man. How are you?
I am well. Welcome back to the show. Excited to dive in and kind of do, by the way, you can go back to the other episode. Just look up Capital Gains Tax Solutions, Mark Willis, and you can find that original episode with Mark's full story. But we're going to do kind of more of a deep dive here, and also a preview for a workshop we're going to be doing here in the future, where you can really see this on paper. But we want to kind of give you some of the top secrets here to building your own banking system. So with that, Mark, give our listeners just quickly about your current focus, and then we'll dive right into the 3 secrets.
We all have to buy stuff in life, and the coronavirus changed a lot this year for a lot of our investors and a lot of our clients, but there are a few things that haven't changed. One thing that hasn't changed is our need to buy stuff. That heater is still going to need to be repaired before winter comes, so to speak. And also, one other thing that hasn't changed is the function of banking. Banking is a part of life. It's as old as human civilization. Brett, I was reading a book called Debt, the First 5,000 Years. Talk about a title, right? So as long as we've had human civilization, as long as we've been out of the caves, the concept of banking has existed. And that's one of the reasons why when I was going to college down in Central Texas, there were always 3 buildings, even in the smallest little Texas towns. There was the bank, the bar, and the church. And I kind of started realizing they're kind of connected if you think about it, Brett, right? First you go to the bank begging for money, right? Then you go to the church begging God for, to get a loan. And then you head to the bar when everyone denies you, right? So that's the strategy most people follow in the banking world. We're all sitting on the wrong side of the banker's desk. And as the coronavirus continues to impact our economy, we're starting to see more and more, even as we're recording this in late September, banks are having trouble and there's more higher rates of delinquencies and non-payments. I don't know where things are headed, but the commercial real estate space looks like it has some pops coming. I don't know what the future holds, but that's the point. What else in our financial portfolio can give us the power of banking in our lives. Where else, how else can we recapture that banking function and bring it in-house? If banking is going to be a fundamental part of your financial portfolio, then why not have it in-house? And I know I'm off my soapbox, I promise, Brett, but that's the biggest and most important financial tool in our tool belt. If I could do one thing with my money to make everything else easier or unnecessary, building a personal reserve like a bank and using it for my own personal and business needs would change everything. So that's a little bit about our specialty and what I get so passionate about.
Absolutely love it. So let's dive right into that. So step one, walk us through the first secret to building your own banking system, and then we'll tie that to investing into real estate.
Sure. Okay. So think of everywhere else you could keep cash. Before we jump into whether or not you should have a 401k or a HELOC, or where could you keep your cash for all of your personal needs and also your real estate needs so that it does what you want it to do. Because where you keep your money makes it do different things. It's a different environment, right? If I put a fish in a salty ocean, it's going to thrive, it's going to reproduce, it's going to love life. If I put that same fish on the sandy shore, it's going to die. And the same is true with your money. Where you keep your money makes it act differently. And as a certified financial planner, we'll have quick phone calls with folks, quick 5-minute, 15-minute calls just to say hello, just to answer their questions. And I'd be happy to offer that to your audience as well at the end here. But what I often hear is, hey, Mark, I looked at my 401k or savings account and it's not doing what I want it to do. My money is not acting in the way I want it to act. It's the fish on the side of the ocean. It's the fish dying on the beach, so to speak. And so keeping that image in mind, where do you want to keep your cash? I have no way to answer that question for everyone listening today, Brent. But a few key items here is just thinking carefully about what you want your money to do for you. So the very first step in our keys to building wealth and becoming the bank that you've always heard other people have is to think carefully about where you want to keep your cash. What financial vehicle would allow you to do what banks do? Well, one of the first and best things we'd need is the ability to leverage our cash and the ability to use that capital for all of life's purchases. Right there, the savings account and the CDs and the money markets, they all fail that little litmus test because we can't really use our savings account for leverage. It's just 10 grand is what you got, 10 grand in your savings account. So the next thing you'd really want to do is think about, well, okay, where can I use that money and have it accumulate even when I borrow against it? So just like banks, right? If I have a bank and I own the bank down the street, and Brett, let's say you walk in and you deposit 10 grand into your savings account. Let me ask you this question. If you put 10 grand into a savings account, how much of that 10,000 does the bank have to keep on reserve at the bank?
I want to say 12 to 15%, but I'm not sure.
Yeah, that would be frightening even if that were true, but it's way worse than that. Just to keep 12% of my money, where's the rest of it gone? Right? Well, they loaned it to the guy behind you in line, asking for a loan. But actually, the worst case scenarios are, for mega banks, it was 10%, and for credit unions, it was 3%. But that was before the coronavirus hit our shores. This year, as a part of the CARES Act, they removed the reserve requirements completely for all banks. $0 have to be kept on reserve of your deposit to loan me as much as possible, or whoever else the borrower might be. Brett, does that concern you? Like it concerns me?
It does. It even concerns me at 12 to 15% now that I think about it. I haven't really thought about it before like that. But yeah, now there's zero reserve. So if I put 100,000 with the bank, they can literally just take that 100,000 and loan it to somebody else.
Now, what are they doing? They're giving you what, maybe 1% if they're generous, and then they loan it all out to me at 10%. That is what we call an infinite return. Why? Some people would say 9% is what they got there. No. How much of the bank's money did they have in that deal?
Zero.
They got your cash, they loaned it to me, and they're taking the spread. Now, why do they get that privilege? just because they say the word bank on their building. Couldn't you do the same thing with your own capital? Absolutely, yes.
Yeah, why not? Tell us why.
Yeah.
Tell us why aren't more people doing this?
Well, the hidden fact is that this is what banks are doing. They're using a little known variation of life insurance to be able to be part of their tier one capital. And part of their capital reserve requirements that they used to have before coronavirus was to keep all this money into life insurance. It's part of their reserve requirements to be FDIC approved. So do what banks do with their money. Don't listen to what they tell you to do with yours. That's kind of my mantra. Do what banks do with their money. Don't listen to what they tell you to do with your money. If they tell you, put your money over here with our bank account, or hey, borrow money from us, don't do that. Watch what they do and go do that. And what they do is they open up huge life insurance policies. Google the words bank-owned life insurance and just see what I mean. Hundreds of billions of dollars with Wells Fargo and Chase and Bank of America and the rest of them. So step two, after you've decided what you want your money to do for you, step two of becoming your own, as in the path of becoming your own source of financing, is to do what banks do and open up a whole life policy, design the bank on yourself way so that you can use it as a line of credit for yourself. Now, it's not literally a bank, it's not an FDIC insured bank, but it is a source of capital that works like a bank, and you can borrow against it like a bank can and leverage your assets and help increase your cash flow. So I'll hush for a minute. I'm saying a lot. Why don't I pull over for a while?
Yeah,
Brett,
no,
what's
I
on your
love
mind?
it. I love it, and I'm hearing about it because my initial thought was, don't buy whole life, right? There's a lot of different ideas out there, right? Just buy term. But if I'm hearing you right, you're saying, well, if you're already putting your bank 100, let's use 100,000 to keep it simple, 100,000 at Wells Fargo, Bank of America, right? They are taking that money, no reserve requirement, loaning out to somebody else, making the spread. And what you're saying is, do what they do, and they put it into life insurance. So why don't we just mirror what they've already done? Some of the wealthiest people in the world own banks or are the banks, right? So become your own bank. So the first thought comes to mind is, all right, so we just mirror that. But where FDIC insured obviously comes up, right? Where are my protections? Where is the actual funds held? Give us some of the architecture around this.
Yeah. So you'll rightly bring up the fact of FDIC insurance. That's totally like where banks have kind of fallen back on. But think about it this way: where is FDIC's big bucket of money? They don't have it. Last time that the banks failed, what did they do? They went to taxpayers to bail us all out, right? Well, who are taxpayers? The same bank depositors at that bank, right? So we have very little in the way of insurance even at FDIC. So insurance companies themselves are not allowed to build up. They're not allowed to fractionally reserve our money. They're not allowed to inflate the money supply like that. So at insurance companies, the reserve requirement is actually more than 100% of your contributions, or what they call premiums, at the insurance company. So contrasting between a bank, even in good times, a life insurance company is regulated by the states to have more than 100%, 10 times as much on the books on reserve than a bank would. Why do they need so much on reserve? Because the life insurance company has to pay out that death benefit if I pass away this afternoon. Banks don't have to do that kind of multiplication. If I die this afternoon, my family just gets the 10 grand or whatever my savings account says. If I died today with a life insurance policy and I'd put 10 grand of premium into that policy, my death benefit might be $1 million. So they have to keep all that money at the insurance company on reserve in case my family needs it this afternoon. And that's why life insurance companies are safer. Literally, the math says 10 times as safe, even in good years, even pre-COVID years, than a bank would be.
Great. I'll make sure I capture that, right? So their reserve requirement, taking the word bank and life insurance out of the picture for a second, life insurance has to keep 100%. You put $100,000 in, they need to at least keep that $100,000 in, maybe a little bit more. Whereas the bank has to keep 0%.
Correct. This year, now in times past and maybe in times future, hopefully we get back to a normalcy where banks are doing a wonderfully generous 3 to 10% on reserve.
Right. Exactly. So that's
Back to prudent times. Yeah.
still not very, big vote of confidence there. Okay, so now let's connect this to real estate, right? Because a lot of our folks are not, life insurance people per se, unless they're ultra high net worth and they're taking some stuff and trying to offset their taxable estate, which is kind of another topic we can touch on. But so your typical multifamily investor, he's got his money sitting at Chase Bank, $3 million. He has loans of, let's say, not typical, but this would be a high net worth person, $10 million worth of loans. The bank requires this $3 million to be the reserve in order for them to loan out that $10 million. So I want you to mirror that with a whole life insurance policy now. And
Sure.
how am I going, Mark, I want to buy this multifamily property. I want to get $10 million. How am I going to do that? Is the life insurance policy going to loan me that money?
Let's talk about it in two scenarios. This is awesome. I love it. So $3 million in the bank, $10 million loan. Did I hear that right?
Yep.
All right. So one option is, hey, Mark, I don't like that banks don't keep any kind of insurance on my $3 million security at the bank, right? My deposits are not FDIC insured up past, what is it, $250,000 right now. I want a safer place for my money to live while I have that $10 million loan out. So very often I'll help high net worth individuals move money out of a savings account and into a whole life policy where they still keep liquid cash of $3 million. So that cash value in the life insurance is, now $3 million, and the death benefit is much more than that. So right there, they collaterally assign, that's the fancy word, they collaterally assign that $3 million to a bank to get a loan for, as you mentioned, $10 million. Banks love collaterally assigning cash value life insurance from the borrower. I'll tell you a quick story. This is a podiatrist, a foot doctor, who had a policy for just 40 grand, taking it all the way down the ladder. He had a whole life cash value of about $40,000. He's a foot doctor and he wants to open up a practice. And so he, goes into the bank, hands his life insurance policy over to the banker and says, hey, I want to collaterally assign my life insurance to get access to your bigger bucket of money over here, Mr. Banker. And the banker gives him a loan for $250,000 to open up his foot practice. So banks love using life insurance as an asset that they can use as collateral to give out traditional financing. So you don't have to be teetotaler here to be your own banker and never ever darken the door of a bank ever again. So, but that is one option where you become more borrowable and more lendable, let's say, to a traditional bank than you would have had if you had just, been using your car or something else for your collateral.
Got it. So let me ask this question real fast. So let me make sure I'm gathering this. So I have a $3 million whole life insurance policy, or I have $3 million sitting with Chase Bank. Are you saying that I walk in, they're actually going to probably give me more money if I walk in and I collaterally assign this life insurance policy of $3 million to the bank than they would if I had $3 million sitting at their bank?
Yeah, think of it this way. They know for sure whether you live or die, they're getting that money back.
Mm-hmm.
So, and they might even get a multiple of. So that gives you more leverage when you're getting that loan. Maybe it's a better interest rate. Maybe it's a larger line of credit from the bank. So absolutely, yes. It comes down to all your particulars, but the vast majority of cases I've seen, you're more borrowable when you've got a life insurance policy and a cash value you can collaterally assign. Helped a gentleman who's does power generation for his business. He sets up, power walls and all that good stuff, generators. He uses his policy as collateral for a regular bank loan all the time, so he can keep it on a debit card. Mm-hmm. Life insurance policies, you don't have a debit card attached to your life insurance. You can usually borrow the money out of a life insurance policy in about 5 business days. Mm-hmm. Some business owners, that's plenty of time, no problem. Other people want that debit card, quick access at Home Depot. So he collaterally has assigned his life insurance over to the bank to have that ready access line of credit with a debit card or credit card or whatever.
That makes sense. And the line of credit might be, what's the interest rate on average on that right now?
At the bank?
Yeah.
I don't know. I think his is like 2%, something real small. So Nothing too bad.
So what would someone be missing here? So if I'm a multifamily investor buying deals and I've been doing it the traditional way, why would you say, no, keep doing it the traditional way? In other words, why wouldn't somebody do this?
Well, okay, and then we'll kind of get to that other idea there too. So yes, it still costs money to set up a life insurance policy. If you think about setting up a bank, You need about $250 million for a massive bank, or at least 10 to 100 million for a small community credit union. And you need to wait about 10 years or so to get a bank charter in your state. It's a massive undertaking to set up a quote bank. But these policies don't take nearly as much capital, but they do still take time. So don't do this if you need get rich overnight rates of return. The costs of insurance do still have something to say, even in the first few years of a bank on yourself type policy. We try to squeeze the expenses down, Brett, as hard as we can and make this cash efficient as much as possible, cutting the commissions, the insurance death benefit, and making it all about the cash value accumulation. That's typically our main focus for most folks. Of course, everyone's different. So don't do this if you need overnight results. Although I will tell you, I've had folks dump in, $100,000, $200,000, and then borrow. In one example, a 60-year-old lady, she dumped in $200,000. She borrowed out $190,000 within about 2 weeks of starting the policy. And she used that money to go fund a new piece of real estate. So she sold one real estate deal. She used it to buy the next real estate deal. And now the policy is growing. We haven't talked about this yet, Brett, but the policy continues to grow even when you borrow against it. So in her case, she lost 10 grand right there. Did you notice that? She put in 200, she borrows out 190. There was an expense of $10,000 there. So don't do this if that bugs you. But for her, she dumped that 190 into a brand new cash flowing real estate deal. The policy continues to grow on the full cash value, even the amount she borrowed out. The real estate is appreciating in the neighborhood, as long as Zillow says it does. And then the renter is paying her cash every month, which she's using to pay off the policy loan. And it's a tremendous system. She's brought that entire banking function back in-house.
Absolutely love it. And I want to, listeners, we're going to do a workshop with Mark, okay? And we're going to do a PowerPoint and a webinar. And he's going to walk through with arrows slowly how and why this works. And this is often what I do with the Deferred Sales Trust, because it's multiple parties, right? And until you see the arrows and watch where the money flows and where it goes out and why it's doing what it's doing and where it's going and how it's going, then it takes a while to click. But once it clicks, it makes sense. So let me try to encapsulate what you just said. So $200,000 goes into the whole life insurance policy. Immediately, 5 days or so, she uses that to collateralize a loan. She collaterally assigns it to the bank to get a loan for $190,000. She goes and buys that real estate. In the meantime, this $200,000 is still growing in its value, okay? And she's buying, let's say she goes and buys $500,000 piece of real estate. Was that the down payment, right? That she was able to use that for that 190 to buy a $500,000, or did she buy it all cash?
In her case, she bought it all cash. And I'll even go back and, I'll let you finish your thought. But yeah, that was a full cash purchase in her case.
Okay, but could she have used that to buy something like a $700,000,
Definitely.
Down payment? Okay.
Definitely, yeah. Mm-hmm.
And then now she's cash flowing, she's doing that, she's getting the depreciation. But in the meantime, had the money just been sitting at a bank, right, and the bank just given her that loan, she's losing out on that arbitrage. Now, she did cost $10,000 to set up, right? But that's also why the bank has been set up 10 years ago and all of their marketing and all of their stuff, right? So we'll take you some time to recoup that return on investment, if you will. What's the average return on that investment for that 10 grand?
Yeah, and not every policy costs $10,000. It's all proportional, guys, to your specific situation. You could start these at a couple $100 a month. You could do a couple $100,000 a year. We've got clients doing both. The expenses are all proportional, and we try to keep them as lean as possible. Now, for her circumstance, the rates of return on these policies will be nice and conservative, beating other cash equivalents in your portfolio. I've seen it as low as 3%. I've seen them as high as 6.5% after tax. So it's really just a middle single-digit rate of return inside the policy. Let me share one other little tidbit, little juicy piece of meat to get people excited about this workshop, Brett. She could have used a bank down the street, like the ones we know about, to collaterally assign that policy. She could have done that. In this case, however, she used the policy loan feature. Inside the contract of the insurance policy itself, if it's a true policy designed the bank on yourself way, it's got to be this or it doesn't work. You can borrow against the life insurance policy from the insurance company, and there is no loan underwriting. So you don't have to prove eligibility for this cash. You can get the money in about 5 business days, no questions asked. You can set up a loan repayment schedule or not. There's no required loan repayment schedule if you borrow against the life insurance policy itself, rather than going to the bank down the street where they will set you up on a repayment plan, right, on their schedule. When you have the policy loan feature enacted, when you use your life insurance as collateral from a loan from the insurance company, then you can set up that repayment or not. And if you pass away and never pay off the debt, off the loan, it's just deducted from your death benefit, right, when you pass away. So in her case, she actually didn't collaterally assign it at the bank down the street. In her case, she could have, but she used the policy loan feature, which let her borrow out 190 grand, and the policy continues to pay her as if she had never borrowed the money out. And she's in control of repaying that loan on her own schedule. If the renter skips a few payments, cough, cough, hey, I got the coronavirus, I'm not going to pay you right now, then she doesn't have to repay that policy loan to the insurance company. It's up to her. And that provided her an extra layer of security and peace of mind because she's the one in control. She's the banker. Now, no other outside bank was involved in that deal. She was a cash buyer when she bought the house, and she's paying the loan off on her own terms. It's tremendous.
It is tremendous. No loan underwriting, no required loan payment in place. And if for some reason the person defaults of not paying rent, and you're not having to force back and negotiate with the bank, or the bank foreclose on you because you are your own bank. Yep. And worst case scenario, you lose the property. What would happen then if the collateral fails, or the property you own fails? I guess you lose that 190, right, yourself. And then
your policy continues to grow as if you'd never taken that money out. So you lost the real estate. If the real estate burnt down, you didn't have any renter's insurance or any kind of insurance on that property, I should say, property insurance. Then what? You lost the property. Hopefully you had property insurance on it to make you whole. But the life insurance continues unabated. There's a loan against the policy that we'll want to pay off someday. But the worst thing that could happen is you find another rental deal to help you pay off that policy loan over your lifetime, or just pass away and leave, the net death benefit to your family.
Got it. So term, does this work for term? Can I sign my term life insurance policy to a bank?
Oh, yeah. Good question. No is the short answer. No, because there's no equity with term insurance. All we have is a death benefit, a future asset. What we want are current assets. Bankers love current assets. They cannot really sign your name next to a future asset like a death benefit that might not happen for the next 10, 20, 50 years. They need current assets, and that's whole life insurance. I've got one more little goodie for your listeners, but do you have another 2 minutes? We can run through this.
Yeah, let's do one more goodie. Yep.
All right. So you guys know DSTs like the back of your hand. You're amazing listeners of this podcast. I'm probably learning more than you guys are at this point. I'm on the up steep curve here, but you tell me, Brett, if this makes sense. What if you had a DST set up, Deferred Sales Trust, that was paying you some sort of regular scheduled deferred payment, getting that taxes spread out over, say, 10 years or so, and you had that cash flow coming in, and you wanted to put that money somewhere for future growth opportunities or tax-free income in retirement or just saving for your legacy? What if you funded a life insurance policy, let's say for 10 years, something like that, out of your DST, and put that into a cash value life insurance policy like we've been describing? That's the funding source for one of these policies. I have a guy here who's 45. He's putting in 32 grand a year into a policy. After 10 years, he has $400,000 of cash value and a $2.1 million death benefit income tax-free after the 10th year. Now, that's pretty rocking cool because he can then borrow from that $400,000 and invest in some more real estate, or just take the money and walk away and it's his cash, or turn it into a tax-free income stream. Under current law, these policies are income tax-free. So now you've taken the DST money that you've been receiving, you pay your taxes slowly in a smart way, to, spreading that pain out and putting it into a never taxed again life insurance policy. Under current law, you can get the money out income tax-free and leave it to your heirs. Rather than just leaving them 400 grand in a savings account, you can leave them $2 million income tax free as well. So thoughts on that, Brett?
Yeah, you blew my mind. Was my first thought, Mark. And we're going to go through that in the workshop. This is why we're going to have Mark, who's so smart, and we're going to be strategic aligned with all of these things here in the future, because it does take specialists. You want the deferred sales trust, brain surgeons, right? You want the whole life infinite banking specialists like Mark, Willis, and then connecting those two is when your dream team comes together to overcome any false beliefs or the things that you haven't been introduced to, right? Because you can't have a jack of all trades to give you all of this knowledge and wisdom. And so I want to try to encapsulate that because, what you're saying is absolutely what the deferred sales trust is able to do. Let's just imagine you sold a $10 million asset and you had a zero basis, okay, and you owed about $4 million in tax. Well, you could sell that and then you could, pay all the tax, or you could sell and move all into the deferred sales trust. And now you have an extra $4 million working for you, and you can invest it into stocks, bonds, mutual funds, investment real estate, and now that's producing some income. Okay, and now that income that's coming off, you could use that to fund a whole life insurance policy. And now when it's there, now we have a chance to build that up for a big cash value, right, over a period of time. Yep. So you're using the money that you would have paid to the government, the $4 million, right, let's say. And let's just even say that $4 million is earning, our average trust, 10 years, over 10 years, net of all fees, about 8%. But most of our clients are somewhere around 5 to 6% of the money per year are taking. So let's just say 5%. That's $200,000. If they just took $50,000 of that 200, right, and use that to fund a whole life insurance policy.
Yep.
Now you're going to pay the tax on that income that comes out of that 200. So you're going to pay just ordinary income tax on that. So after tax, then put that into the whole life insurance policy. Build that up. Now fast forward. Let's just say that's worth $3.5 or $4 million, right, for the liability that you would have paid. You die. Your kids can walk in, and now they can keep the deferred sales trust going if they want to, but if they want to cash out completely, you could use that to offset because that's tax-free. You just wash that away. In the meantime, you got out of the toilets, the trash, the liability, right? You sold at the optimal timing, hopefully high. You diversified. You got liquidity. You got out of debt. And you use one extra layer. I'll call this the infinite banking ninja strategy, right? Yeah. To also get some additional savings. So all that being said, Mark, is that a fair summary?
Oh, love it, man. Yeah, what you just did was you multiplied the money. You got that money working harder for you than you ever did for it. And that's the key here, guys. So you're working with a ninja with Brett, and keep listening to his awesome show. Blowing my mind, man.
Thank you, Mark. And so look for that workshop to be announced pretty soon. We'll probably do it in the next 3 or 4 weeks. And please rate, review, subscribe to this podcast. Mark, I want to thank you for listening. Thank you for being here. I want to thank our listeners for listening, and appreciate having you on the show. And with that, remind our listeners where they can find you if they want to reach out to you right now.
Yeah, find us at notyouraverageFinancialPodcast.com, notyouravagefinancialpodcast.com. That's the shortest website link I think I've ever had to come up with. So, and then just click on request a meeting if you'd like to chat for 15 minutes over phone or Zoom. Happy to do so.
Beautiful. And I want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust and considering a whole life policy with Mark Willis for infinite banking may just be the best way for you to grow your wealth. We can't wait for the workshop that's coming up. Please rate, review, subscribe to the podcast, and share this with somebody who could benefit. We appreciate you. Thank you so much for listening, and talk to you soon. Bye.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.